Hey, morning, Sarry.
Morning, Alex. How are you?
I'm good. How are you?
Good, good. Thanks. How's everything going?
Yeah, so far so good. So far so good. Just going through the day here, afternoon here, morning for you.
Yeah,
So,
yeah,
how
yeah.
is your day so far?
So far, so good.
Yeah,
Yeah, started off kind of busy for the day, and
yeah.
I've got 5 podcasts to do today.
All right.
So,
Wow. So
yeah,
busy man.
yeah.
But not surprising because you've got quite a very interesting content offering for listeners. So yeah, that's really good. And thank you very much for actually, agreeing and contacting us to come on the podcast because there'll be quite a lot of people of our listeners who will be very interested to listen to what you have to offer and how it can actually save them a great deal as well of their wealth and everything else within their estate and wealth management. So it's really good of you to come on and talk to us. So
Yeah.
um, I guess to begin with, we'll probably just set the scene in terms of just give us a little bit about yourself and a bit of a background on the bank on yourself as well. Is that okay?
Absolutely. Yeah.
Mm.
So a little bit about me. I've been in the insurance and financial services world for about 5 years. I started off working for a company called Allstate Insurance as a business consultant, and then I went into Medicare, where I would help retirees, people who were like 64 years old, merging from their employer plan to their own individual owned Medicare plan. So I would help them make that transition.
Yeah.
I did that for a couple of years, and then one of my clients at that time asked me if I could help him with life insurance. And he
Wow.
even mentioned something like it has cash value, it grows over time. I didn't really understand much of what he was saying, but I told him I would do research. We had a good relationship, and I told him I would do research for him and get back to him. So one of the ways I like to learn is I like to read books, and I went to Amazon and I searched for books about life insurance. And this book came up called The Bank on Yourself Revolution by Pamela Yellen. And what the book pretty much talks about the bank on yourself concept. It's also known as the infinite banking concept. And it's
Yeah.
pretty much the utilization of cash value, whole life insurance, mainly for the cash use rather than the actual life insurance use.
Yeah.
And what that means, Alex, is that whole life insurance has two functions or two purposes. One is the actual life insurance part, and the second is the cash value part. The cash value is almost like a savings account inside the policy, but this has a lot of benefits that people don't know about. Even insurance agents and financial advisors don't even understand this part. But it has cash value that grows over time. It earns dividends from the insurance company. It increases in value regardless of market conditions, and you always have access to this money. So this, after finding out about this, after reading the book and reading other books to talk about this, it kind of opened up my mind and shifted my career. I went from more of Medicare insurance. Now I'm more into financial planning. I still do Medicare, but now I'm more into financial planning, and I help specifically real estate investors and business owners grow and protect their money at the same time. So
Yeah.
I'm sure we're gonna get into a lot of things. So feel free to ask me whatever you want.
Yeah, wow, that's really good, good concept. I think even for me, when I first heard of it, it was quite an interesting concept to understand because the essence of it, of what I grasped, was that you are able to hold both in a way. That if you're looking for lending, for example, from someone, you can actually do that without compromising your cash asset, which will still earn you dividends. So I guess let's start off maybe breaking it down in its simple terms, like how does it actually work? So maybe let's take an example. For if we say I am looking, for example, to buy a house or an asset. So typically I will go to someone or like a financial institution to borrow that money. So all I have now is the loan, which is that liability on that aspect. But if it's something where I had to put a deposit on as well, then I have also put my money into there. So I've actually lost that money in a way because it's gone. I've got the liability. I'm not earning anything on that. So that restricts me in that sense. But from my understanding of the bank on yourself concept, you can do exactly the same scenario, but without losing the benefits that you would get or the returns that you would get on money. Is that a correct understanding?
Yeah, that's exactly the case. And I'll give you an example.
Yeah.
Let's say, for example, you have a cash value whole life insurance policy, and you have $100,000 in cash value in the policy. And
Yeah.
let's say now you're a real estate investor or a business owner. You come across an investment. It requires you to invest $50,000 of your money into it. There's a
Yeah.
couple options you could do. You can borrow that money from a lender. You could use cash. But let's say you go to your whole life insurance policy and you borrow from the insurance company. You borrow $50,000 from the insurance company. Now, what actually happens is you're not deducting $50,000 from $100,000 in cash value. You're simply borrowing against the cash value that you already have. So now what happens is you have a loan agreement with you and the insurance company, like a personal loan that you borrowed $50,000 from them. You pay interest on that $50,000. But on your $100,000 cash value, it continues to earn interest and compound interest and dividends as if you never touched it. So eventually what happens is your policy continues to grow and you make money in the policy. It grows and compounds faster and more than the loan you borrowed of $50,000. So then when you kind of compare that to the investment you made, you make money off the investment you made. Hopefully you do. And you make money inside the policy. So your money is doing something for, it's doing two things for you at the same time.
At the same time.
And this is a really good thing because a lot of business owners have this struggle, right? Where like, if, you always need liquidity, you always need cash or access to cash to move around because there are delays in business. By the time you get paid, by the time you get clients, by the time you sell a property, there's a lot of delays. So you always need liquidity or cash to survive in business. But at the same time, the contrary to that is you never want a lot of cash sitting in the bank because you lose interest on it, you lose opportunity costs, you lose to inflation. There's a lot of risks involved with just having money sitting in a bank account. So you want to be able to move it around. So I think this concept brings it right in the middle where you can move your money around but still have it grow as if you've never touched it.
Yeah. Wow, that's great. Now you talk about you talk about it as an insurance policy. Does that mean, because obviously normally under insurances, what is involved is I take an insurance for a fixed amount of money and I'm just paying like monthly premiums towards that. Does this work in the same way, or is there like just a one-off premium for your cash value, or is it monthly premiums? How does it all build up for your cash value that you have in the policy?
Yeah, so there's a couple of different ways to fund the policy. You could fund it monthly. Every month you can make a certain premium payment. Let's say, for example, just to choose an even number, let's say $1,000 a month. So when you're putting $1,000 a month into the policy, a portion of that money goes towards the cash value, another portion goes towards the death benefit or the life insurance part. So the point is that your money is doing a couple of things for you at the same time. A portion goes towards the cash value and a portion goes towards the life insurance. And then depending on the company, depending on the age, depending on the financial situation, there's different levels to it. It could be like, for example, like 50-50 split. Like every dollar you put in, half of it goes towards the cash value and then half of it goes to servicing the life insurance. And eventually the cash value will build up over time, or you could pay the policy annually, one-time payment for the whole year. Or you could even do a single premium whole life policy. That's just a one-time payment. It could be like, for example, I've worked on many of these where it's like $500,000, like $500,000, just a one-time single premium transaction. And as soon as the client does that, they instantly have two benefits. They have the cash value and they have the death benefit or the life insurance part. And then both of those grow. So we always do a financial analysis with clients to figure out what would work best for them, because it's hard for us to guess. So we have to do like a proper diagnosis to figure out what solution would be best for them. And then based on that analysis, we build them a personalized solution. We show them which company, which product, the amounts. We'll either do it monthly, annually, single premium, or a combination of all three, Of
all three. Okay, that's great. And is there any limits in terms of how much cash value or the sort of death benefits that someone can actually get? Is there limits on that? Like you can't get a policy for, let's say, $20 million or $10 million. What are the limits within that?
Yeah, so you can get any life insurance you want as long in the United States, at least speaking, and Canada is probably the same way. It has to be about up to 25 times your annual income. So if you make, $100,000 a year, the maximum you'd be able to get is $2.5 million in the death benefit, which would probably equal maybe in the first couple of years, like $100,000 in cash value, give or take, in the first couple of years. So that's kind of that's how they measure it, based off of your annual income and up to 25 times your annual income.
Yeah. Okay, I see. And okay, and in terms of timeline, does it have a specific timelines? Like I'm contributing for let's say, is it 20 years, 5 years, or you can pick? How does the timeline aspect work?
Yeah, good question. So you can control the time period. We could do, you can set it on for 5 years, for 10 years, 20 years, or for your whole life. You just keep paying into it and you always have cash building up. Or again, single premium, which is a one-time payment. So again, it's hard to measure, but we could do it based off the financial analysis. We could figure out, like, for example, if somebody is 65 years old, or if they're 55 years old and they want to retire by the time they're 65, then it would make sense to do a 10-year policy for that person. But if somebody's 20 years old and they want to get into the habit of saving for the future, then there's no rush. There's really no reason for that person to do a 10-year policy. They could do a 20 or 30-year policy and extend the periods of payments that goes into the policy, and for them to have a longer period of time to earn compound interest. So it depends on the age, it depends on the retirement goals, what they're currently doing financially, and we kind of put it all together to improve their financial situation.
Yeah, I guess that's where, like you said, the financial analysis of each individual situation comes into play. So at the end of the policy, let's say it's a 5-year policy or 10-year policy, do you then just get to realize the cash benefit, just take that as cash, or what happens in that event?
So when you're building up the policy and you have cash value, you could use it for whatever you want. Let's say you fast forward, you've paid off the whole policy, you have like $500,000 in cash value already built up in the policy. You could turn it on for retirement income, like I want $10,000 a year for the rest of my life, or you could withdraw larger amounts. You could use it for business purposes. There's no restrictions or like regulations on what you could use that cash for. You could use it for whatever you want in any frequency one. And also, you don't have to wait until you're in retirement years to touch that money. You could essentially, year one, put cash in and then borrow from a portion from that from year one. So like almost instant liquidity, and the liquidity is guaranteed too. You never have to qualify for the loan. Like you never have to go through underwriting for the loan. The insurance company will always give you up to 90% of your available cash value. At any time, you just fill out a form, you send it into the insurance company, you ask them they ask you which account you want to transfer to, and then they deposit it in that account, and then now you have a loan agreement between you and the insurance company, and then you can control the payback period. If you miss a payment, it's not like anything's going to happen, but you want to get into the habit of borrowing and paying back that money within reasonable time.